Hello and welcome to the second video installment at the Expat Teacher Network. We'd like to start by reminding people to visit our website, expatteachernetwork.com, as well as or our Facebook page, which you can find under the same name. Right, two disclaimers, the same disclaimers we did in the first video. One, to mention that we are not certified financial experts. We are not licensed to sell insurance or other investment products. All that we're hoping to give or offer with these videos is information, to pass on information that we have learned through research and through reading and through our own life experiences, and hopefully so that our fellow expat teachers won't make the same mistakes that some of us have made. Second thing to mention is that it's a video series. It really is very helpful if the first video is watched before the second video, because some of the things we'll be talking about today in our presentation depend on information in that video. And if you haven't seen it, then it's a bit confusing. Okay, so let's get started here. Today we're talking about money owning versus money lending, the magic of compound interest. What does all that mean? Well, today we're going to cover some of the basic principles and sort of almost philosophies behind financial planning, what goes into making a good, solid financial plan. And we're going to spend a heck of a lot of time talking about the role that life insurance plays in that plan. This will be particularly useful, I think, for those colleagues or people with young families, married with two kids kind of thing. Okay, so let's get into it here. The first concept we want to talk about is this idea of pay yourself first. Now, you often hear, mom and dad or grandma and grandpa say, make sure you put 10% of your paycheck into your bank. Well, we're going to get a little more involved than that. That's a pretty basic sort of rule, simple thing. What we're talking about today is this idea that we mentioned last time of the 50-30-20 rule. And for those of you that saw the presentation, you remember 50-30-20, 50% needs, 30% wants, 20% investments. We're going to be focusing today mainly on the 20%. And as I said, specifically, we're going to be focusing on what role does insurance play as part of your financial plan. So that leads us to the ages-old debate. I first ran across it in the 1990s when I had first graduated from university. Term versus perm insurance. No, not perm, the fancy hairdo you just got at the hairdresser's. Perm meaning permanent. It goes by different names. Whole life, universal life. There's all kinds of fancy names that insurance companies have come up with to market this product. Essentially, the difference between the two is term insurance runs for a specific length of time, hence the name. You buy a 20-year term policy, you pay premiums for 20 years, and then you stop. If you have not died by that point, you get nothing. Permanent insurance, whole life, universal life, you pay premiums for the rest of your life. At least that's the way they used to market it. Today they say up until age 100 because, of course, people actually do live that long these days. But for most of us, premiums that are payable up until age 100 means, for the rest of our whole life. And often you'll hear in this debate, a lot of insurance agents will say, oh, permanent insurance is better because, it has all these different advantages, blah, blah, blah. We'll talk about the advantages in a minute. But basically, one of their main arguments that you need to be able to defend yourself against is if you take term, which is much cheaper, then the rest of that money, you'll simply spend it and it'll be gone. And this is one of the things I would like to argue vociferously against, because the truth is, how do most of us pay our insurance? Frankly, most of our bills. We use what in the EU, in my country where I live, we call standing orders. Actually, we use the German word for it because I live in Germany. Here in North America, if I'm not mistaken, it's called pre-authorized checking. Basically, you allow the company to simply suck out the appropriate amount of money out of your bank account every month, and it's done automatically. That's the kind of thing we're talking about. And my argument would be, if you're already doing that for X number of dollars or euros or pounds or whatever, you can keep doing it. This is not a problem. Okay, so let's get into some of the basics or some of the ups and downs of the two different kinds of insurance. Well, the first thing to say is that between term and whole life, term is cheaper. Now, I do want to qualify and put into context the numbers that I'm showing you here. These numbers are real in this sense. My younger brother is an actuary for a major insurance company in Ontario, Canada. And I asked him point blank, what would such and such cost? What would such and such cost? And these are the numbers that he gave back to me. This is what he does all day, every day. So these numbers for where my brother lives, or for anybody who's a Canadian citizen, these numbers are almost certainly true. Are they true for somebody like myself living in Germany, or somebody else living in the EU, or somebody living in Australia or New Zealand or Singapore, Hong Kong, China, Russia? I admit I honestly don't know. The one thing I can guarantee you with a very high level of certainty is that the ratios are the same, that the cost of term versus whole life will be the same pretty much wherever you live. And any time that it's not, we'll make mention, or any time that these stats are not sort of universally true, or that the numbers we're showing you are unique to a specific country, we will try and make mention of that. Okay, so getting into the figures. Term is cheaper. You see there, $385 for $400,000 worth of coverage for a term 20 policy. Now, I admit, when I asked my brother for these figures, he wrote back and said, okay, well, it's life insurance. It depends on who you are because it's an individual policy. So he sort of gave me the average, and I asked him, what's the average? What's sort of the normal jump off point for deciding costs? And so these figures are based on a 30-year-old non-smoker. So if you're older than 30, these figures will be too low. If you're younger than 30, these figures will probably be too high because, of course, insurance is more expensive the older you get because it's more likely that you'll die. Sorry to say, but it's true. And these figures assume that you're a non-smoker, which I hope all of you are, but statistically some of you are not. So if you're a smoker, then obviously these figures don't hold. Okay, anyway, term policies come in a variety of figures, 10, 15, 20, etc. I've bolded the 10 and the 20 because in the examples and the figures that I was given, those were the two policies that were quoted, because the other ones apparently, my brother was quite surprised to find this out. He said he admitted that it was strange that there in Canada, at least, there's no such thing as a 25-year term life insurance policy. I know there are in other countries, and he admits that that would make sense because most mortgages in North America run for 25 years. And that would be one of the reasons to buy a term life insurance policy, is that if you die while your mortgage isn't paid off yet, your family needs to replace the income, right? That's the basic concept behind insurance. If you pass away, who's left behind? And that's why in the last slide we showed you, said, think of your life situation. It really does depend. So, okay, that's the advantage of term insurance. It's way cheaper. You can see down below there that whole life is more expensive. It costs, for much less coverage, $250,000 worth of coverage. It costs $350 to $380 per month. Whereas the term policy for a term 20 costs $35 a month. That's a whole lot less. However, to be fair, whole life does have other things attached to it that term doesn't have. It has cash value. It has borrowing functions. For example, now the borrowing functions don't exist right away, but some of these borrowing functions can be very useful. If you've had your insurance policy for 10 or 15 years, and sometimes it's as low as 5 years, you can borrow against the policy because you've built up enough cash value. Well, how does cash value accrue? Well, basically cash value accrues the following way. The insurance company, if you go and buy a life insurance policy with Prudential or with Great West Life or with Allianz or anybody, they don't actually insure you. They go to a reinsurance company, of which there are very few in the world. There's Swiss Re, Munich Re. They're the two I know of. I'm sure there are a few others, and I just don't know what they are. And reinsurance companies only sell one kind of insurance, term. That's it. So the insurance company, like Allianz, will go to Munich Re. They'll buy a term insurance policy on you for, say, 20 years at 35 euros a month, if it's in Germany. And they're charging you the 350 euros a month. And they're going to take the difference and they're going to invest it in things like stocks, bonds, all property development, all sorts of things. And of course, one of the things I personally would argue, at least, is if they're buying term insurance and investing the difference, why can't you just do that? See, because if you buy the whole life policy and you allow the insurance company to make a profit with your money, you're a money lender. If you buy term insurance and you invest the difference and you make the profit, then you're a money owner. And that's kind of the general concept that we're trying to get at today, is we want our members, hopefully, to understand the difference between being a money owner and being a money lender. Okay, so here's one last example to talk about to sort of play out the difference. You can kind of tell where our bias lies here, right? Is to look at this example of death benefit, because that's ultimately what insurance is. If you die, they pay out a big whack of money. Now, if the insurance company in that very sad situation has to pay out that big whack of money, Your family doesn't just want to spend the money because then it's gone. They have to invest it. Well, if we can believe our colleague Andrew Hallam, if they invested in the market, they'll average 10% a year return, roughly. So let's look at a $250,000 or euro death benefit from the $3,900 a year in whole life coverage. 10% is $25,000. Question is, would that replace your income for your family? I doubt it. Most of you are probably making more than that. And you're probably living a standard of living or a lifestyle where $25,000 or euros or whatever would not allow your family to just continue living. So, for example, they might have to sell the house, they might have to sell the car. And ultimately, that's what insurance is designed to protect against. If we take a look at the term policy, the $400,000 death benefit provides $40,000, and that probably would replace your income. So here's the bottom line. If you're sitting out there owning a $250,000 or euro life policy that you're paying $350, $370 a month for, you're underinsured. You're underinsured and you're paying too much. So one of the things we wanted to talk about today is that difference. We wanted to sort of make a plug for buying term and investing, the difference in being money owners and not money lenders. Okay, so let's move on here and go to our next idea. The next idea is, what's all this based on? Why buy term and invest the difference? Why not whole life? Why not? Well, if you want to do the borrowing function, and there are groups out there that do recommend it, groups like the Elevation Group, and there actually is a whole website called cashflowbanking.com. That's what that concept of borrowing against your insurance policy is called, and there are advantages to it. It's free from creditors, at least in the United States and Canada it is. It's free from taxes usually because it's life insurance. But what's also true to say is that idea of infinite banking or cash flow banking, again, it goes through it's marketed under a lot of different names. It seems to only be available in Canada and the United States. I actually looked into it for myself living in the EU, and it doesn't work. It mainly doesn't work for one reason, and it doesn't really work in Canada either. Because if you borrow against the policy, then it has to do with the interest rates. If you borrow against the policy, what you want to be doing is doing that because if you took out a private loan with the bank, the interest rates would be much higher. Well, for example, in Canada, that's not true. Borrowing rates on insurance policies are actually significantly higher than you can get at the bank. In Germany, where I live, it's exactly the opposite. Borrowing rates, again, because you can borrow against insurance, the problem is it's not tax-free anymore, and it used to be. All right, moving on here. What we're talking about, really why we're advocating buy term and invest the difference, is this idea of the theory of decreasing responsibility. And we've decided to show it with this simple graph on this fake little iPad or little tablet thing here. The idea is this. You see two arrows here. The arrow that starts at the top, the arrow that starts just underneath the little silhouette picture. So this arrow here, that's labeled responsibilities and debts. You have to look at these arrows like the left-hand side of the screen is when you're, say, 25 years old. And the right-hand side of the screen is when you're, say, 65 years old. So when you're 25 years old, your responsibilities and your debts are usually very high. You have a mortgage, you have small children who are dependent upon you financially, you might have a car payment, you have other things that haven't been paid off yet perhaps, but your savings are really quite low. Why? You haven't been working for very long. You're only just getting out of university, and for some of us, it was a bit of a struggle when we got out of university to find a proper paying job. It took us a few years. And so your savings really are very low, and yet your responsibility level is very high. In this situation, life insurance is really quite necessary. It really makes sense. Again, provided that there'll be somebody left behind. I freely admit, when I was this age, I didn't have life insurance. Why? I was single and I had no dependents. No need. If I die, financially, it doesn't affect anybody. So the right-hand side of our screen, where the two arrowheads come to the conclusion, is age 65, and this is a situation where probably your responsibilities and debts are much lower. Your house is paid off. You've paid off your mortgage. You don't have car payments anymore. Your children are out of the house and are living on their own, and they have their own jobs, and they're not financially dependent upon you anymore. And your savings are much higher. Why? Well, because you've been working for 20 or 30 years, and your salary is usually much higher. Certainly at the school where I teach, we have a salary grid. We have a salary scale, and I'm higher up that scale now than I was when I first came to my school 15 years ago. And so I earn a lot more money. Yes, inflation is also a factor in this, but I'm also able to save more now than I was then. And so that's the theory we wanted to sort of throw at you as sort of the justification for why we believe that life insurance isn't actually something you need for your whole life. Because if you have bought term and invested the difference, if you hit the age of 60 and God forbid you're in a car accident or whatever and you pass away, if you have a brokerage account that's worth, hundreds of thousands of dollars, who cares if you have life insurance? Your family doesn't need it. They'll simply use the capital that you've already and the wealth that you've already built to replace whatever income they might have needed from you, which frankly, if your kids are out of the house and your house is paid off, your spouse really wouldn't need to replace much at all. So that's the idea behind what we're saying today. Okay? Okay. Now let's get into this idea of be a money owner and not a money lender. We've mentioned it up till now, but let's look at it a little more specifically. We decided to do it with this particular graph. I freely admit I stole this idea from a company called Primerica Financial Services. I became involved with them very briefly in the 1990s. I didn't stay with them mainly because it's a multi-level marketing company, and the idea is you go out and pester your friends and get your friends to sign up, and this is how you earn money. And that concept didn't appeal to me at all. But the ideas that they are marketing and some of the things that they're saying do appeal to me. Having said that, I don't invest with Primerica, and I don't necessarily advocate that anybody do. In fact, I had a financial advisor from Primerica. I did invest with them. I regret that. I shouldn't have done it. And I'm going to talk more in video 3 about why investing with a financial advisor is maybe not the smartest thing, or at the very least, we're going to talk about the difference between managed index funds or unit trusts if you're British, and index funds or index unit trusts. Okay, anyway, back to this particular diagram. You can see on the left-hand side, it's very simple. That's you. That's you, the investor. And it's about where do most people go when they invest their money? Whom do they contact, and to whom do they give their money in order to make money? And generally speaking, in most Western countries at least, people go to their banks, they go to their insurance companies, they go to credit unions, we call them in some countries. Like, for example, in Germany, those would be called Volksbanks. In the US, you'd call them savings and loans. Or people will go to some sort of financial advisor from some company like, as I said, Primerica Financial Services. There are just a plethora of companies out there that have the label financial services on their letterhead. And then it's about what these companies turn around and do with this money. What they do with this money is not, they don't sit on it. I used to think so. When I was 10 years old and opened my first bank account with $20, I thought they would, stick my $20 in a tiny little slot in the vault and I could go visit it whenever I wanted to. And of course, no, they take I was very disappointed when the teller simply put it in the drawer. I remember thinking, hey, wait a minute, that's my money. Of course, the bank takes this money and they reinvest it into things like stocks, bonds, property developments, and my personal favorite, loans. They charge their depositors interest to borrow their own money. And of course, what we're talking about today is we're advocating and talking about why it's more sensible to bypass that middle step, to bypass this brick wall, as we call it, of the financial industry and financial institutions who, because they're the middlemen or the middle people, end up making themselves wonderful, wonderful commissions, regardless of whether what they've sold to you works or not. I've myself am trying to extract myself from an offshore pension, quote unquote, that should be double what it's worth, but it has earned my financial advisor 5 figures in commission simply for selling it to me. So, he's done well for himself, that fella. Me, well, not so much, which is one of the reasons that we started Expat Teacher Network. Okay, so anyway, that's talking about money owning versus money lending. We want you to be money owners, right? Don't let somebody else invest the difference. You invest the difference and you make the profit. So then it becomes a matter of this idea of compound interest. We want to focus now on the idea of compound interest and how useful a tool it can really be. The basic concept is this: start early and save more. What do we mean by that? What we mean by that is using the advantage of time. Now you can tell by all my snow on the roof here that I haven't necessarily been terribly good at this, and it's never too late. That's, I think, one of the first messages we would want to send is the sooner you start, the better off you are. And if you can start really early, like before the age of 30, that's a huge advantage, a huge advantage. So let's deal with some specific examples here. We got these off of various sites on the internet. We'll show you our sources at the end. And this one I particularly liked. If I save $2,000 per year and I start at age 20 and I save $2,000 every year until age 30 and then I stop. I never put in another dime. And I leave it in that investment vehicle until I'm 65. And I'm going to assume only a 4% annual rate of return. Some of the examples in the last video assume 10 and 12%. And I can easily see somebody saying, 10, 12%, yeah, it would be nice. But hey, let's talk about rates of return that are actually going to happen. Well, nobody knows the future, of course. So I wanted to kind of lowball some of the examples we use today simply to demonstrate the same point, but perhaps using some figures that might be a little more realistic or a little more seeming to be a little more grounded in reality to people. So, okay, $2,000 a year at 10 years means I had a total investment of $22,000. My overall total by age 65. In other words, if I just left it after that, assuming 4% return a year, how much do I have when I'm 65? $107,209. That means I've made a total profit of $85,209. Well, okay, not enough to retire on, but certainly, not bad, especially when you look at the line of profit. So let's say the next person, instead of doing it in the first 10 years, waited until they were age 30 and then put in $2,000 a year every year after that. So they've put in $2,000 at age 30, at 31, 32, 33, and every year up to the age of 65. And again, they gained a 4% annual rate of return. Their total investment, what they've actually paid out of pocket, isn't $22,000, it's $70,000. And look at the total by age 65. $152,288. Remember, our total in the last one was only $107,000. Okay, I agree, 152 is more, but it's not a whole lot more. And our overall profit is actually $82,200. It's actually less. The actual win is less simply by waiting the 10 years. And to get this slightly less beneficial win, I had to lay out a whole lot more money. That, in a nutshell, is the magic of compound interest, or it's the reason why starting as soon as you can is a huge advantage. Starting at 35, way better than starting at 40. Starting at 30, way better than starting at 35. So what's the message here? The message is very simple. Don't delay. Don't fall into the trap of saying, money's kind of tight right now. I can't really, this 50, 30, 20, I can't really make it happen. Find a way to make it happen. Sit down, track your spending with expense apps or expense manager app on your smartphone or whatever. Use an Excel spreadsheet. That's what I used to do. Do something to find that 20%. Even if it's only 10%, that's still better than nothing. So start as soon as you possibly can and do not delay. Okay, so the one example that I found on the internet, I love this example, is the story of Grace Groner. She's hired as a secretary at Abbott Laboratories. For those of you that want to invest, it's ABT on the stock exchange. That's the ticker symbol. And she started in 1931, 2 years into the Great Depression. Not exactly a good time. She was probably incredibly lucky just to have a job. And she worked for them for 40 years. After 4 years of working behind the desk, typing letters, etc., Grace bought 3 shares of the company at $60, $200 in total. Now, just to put things in perspective, it's 1935. If you went to sort of the classic old American diner for breakfast, bacon, eggs, juice, coffee, toast, 1935 probably would have cost you somewhere between 75 and 90 cents. So let's just put that in perspective. $200, that's a fair chunk of change for 1935. Well, here's the interesting part. Grace never sold her shares. She kept them. In fact, they formed part of her estate when she died. And with all the dividends that she was paid, which she reinvested, with the share splits, by 2010 when she passed away, her account was worth $7 million. Starting at $200 and at $7 million. Now, 40 years is a heck of a long time. Most of us, including myself, we don't have 40 years. But still, I think it's a wonderful, wonderful example to demonstrate how time is your friend and how delay is your enemy. Okay, so then let's talk more specifically about the magic of compound interest, right? And exactly what it can do for you. Okay. And whoops, let me just zoom out a little bit here. Yeah, there we go. The magic of compound interest. Right. This is the idea. Again, I stole this from Primerica. and it's the idea of the rule of 72. And the rule of 72, I'll show you a website in our sources at the end, because I know when I first saw this, I thought, wait, why 72? Like, why not 65? Why not? And I'd seen other numbers used. There is a reason why 72 is used as the mathematical constant. The basic idea behind the rule of 72 is, you can see it at the top there. If you take 72 and divide it by the rate of return, so if my rate of return is 12%, I divide 72 by 12 and I get 6. That equals the number of years it takes your money to double. It takes your investment to double. So why 72? I will show you in the list of sources the URL that will explain this. There's a big, huge mathematical formula. Basically, the URL or the web address that you want to get stuck in your head, I'm not making this up, I promise, moneychimp.com. It has an explanation that's far more mathematical than anything I could ever hope to understand. It also has a compound interest calculator, so you can plug in an amount and a rate of return and see how much it'll be worth in 10 years, 15 years, 20 years. You can fiddle with that and see how much you need to be saving a month. You can use that to sort of calculate backwards, like, okay, if I want this much by the time I'm 65, how much do I need to put away every month? It's brilliant for that. It's absolutely brilliant for it. It's wonderful. It's easy to use. I use it liberally. I first ran across it in Andrew Hallam's book, Millionaire Teacher. And I am grateful to him for putting me onto it. Okay, so these are just two examples. And combined with this is what I really wanted to show people here is exactly how banks and insurance companies make their profit. So let's start with one example where a 25-year-old goes to his investment counselor, be that at the bank, the insurance company's financial advisor, whatever, and they say, I can give you a 6% annual rate of return. And according to the rule of 72, 72 divided by 6 means his money will double, or her money will double, every 12 years. Right? And you can see that I've laid out the example there, right? At 25, they have $5,000. At 37, $10,000. By the time they hit 61, so reasonably close to retirement, they have $40,000 or euros or whatever. And that's not bad. As rates of return go, that's pretty good. After all, they only put in $5,000 and they didn't really have to do anything after that. But the bank or the insurance company will then take that money, that $5,000, and they'll invest it themselves. And because these are all publicly traded companies, or at least many of them are, we know what they earn. And trust me, 12%, my example here, is very conservative. Most of them actually earn more than this. So if you double the rate of return with the rule of 72, that means my money should double every 6 years. And normally when I was working in the financial services industry, which I admit I did very, very briefly, when I would lay this example out, I wouldn't have all the figures. I would ask people, if I double the rate of return, what would you expect to happen to my total? And guess what most people said? Oh, it should double. Well, if you look, because it's doubling every 6 years, it means it's doubling half as fast. So you look at that bottom line there, by age 60, it's not 80,000, it's 320,000. And thank you very much, Mr. or Ms., you gave me your 5,000 because I promised you 40. So 320 minus 40 is 280,000. And I get to keep $280,000 worth of profit. And what did I invest? Zero, because it was your 5,000 that you worked hard to save. Well, that's the difference between money owning and money lending. See, the person that invests themselves and can get the 12% or the 10%, they end up with the big pot of 320,000. And that's the magic of compound interest. In his book, Millionaire Teacher, Andrew Hallam called it the snowball effect. I think that's a really, really good analogy. That as you start out, you think, boy, this isn't doing very well, and I'm only earning a little bit. If I start with $100 a month and 10% is only $10, and then 10% of 110 is only like $11, I mean, boy, that doesn't really seem very good. All I can say is this: patience. Patience, and allow time to be your friend, because eventually, as you can see with the bottom example, when I hit like 48 and I've got 80,000, suddenly I'm doubling it and it's 160, and then I'm doubling that and it's 320. And if I waited until I was 66, then it's 640. Then you're into serious money. Then you're into serious gain. And it really is like a snowball going down a hill. That the bigger it gets, the more snow it can attract. And by the time it hits the bottom of the hill, it's a massive boulder. And that's the key to building wealth. And that's the key to building wealth, by being a money owner and not a money lender. Okay, I promised sources. Here they are. Here are the sources: choosetosave.org, primerica.com. NASDAQ, we had an article off the NASDAQ. The moneychimp.com features Rule 72Y, that middle bullet point there. That's the one that'll tell you or give you the calculation for the formula for why the rule of 72 works, like why 72 and why not 28 or something like this, right? So those are our sources that we used for this particular presentation. So we hope you learned something today, and stay tuned for the third installment. It's going to take a while, I think, before we can actually get that up, but we're going to talk about the difference between indexed funds and managed funds in that one in particular. But the message today is twofold. One, buy term and invest the difference. Whole life, well, maybe under certain circumstances, but not necessarily. Take that money and be a money owner, not a money lender. You invest the money. You earn the profit. Don't give it to the banks and the insurance companies or your financial advisors. They've got enough. They don't need your help. Help yourself and help your family. So thanks very much, and hopefully you'll visit us and join us at expatteachernetwork.com, and we'll see you next time.